Yeah, and we're live. Welcome to a new market cap, everyone. We're gonna get this show on the road. Um, Darren, I think we're gonna start off the way we usually do, looking at some price action.
Yes,
Um,
sir.
I'm gonna pull it up. What do you have for us, sir?
So, you know, this time of year, it's always a bit hit and miss for people. We had an incredible run throughout the last few weeks in the summer, and then we saw our favorite friend, volatility, come into the fray in the build up to the Jackson Hole banking event. Was it de risking, hedging going into the event? Because, we saw some really big pronounced swings in Bitcoin. It went as low as around 109K. But then after Jerome Powell's Jackson Hole speech about the potential rate cuts coming, we saw the price rebounding. So, this was a real whipsaw like event. And a little bit of trivia, maybe for some of the guys listening out there, is you might often hear people refer to August as a ghost month, right? And now, actually, there is some important things around this because between August and early September, within some Asian cultures, it's seen as bad luck, a period of bad luck. Investors and businesses can traditionally avoid certain financial moves, such as big investments or ventures. So, at times, we might see this cultural practice influence trading volumes in Asian markets, specifically like Binance and OKX. You look over the August period for a long, long time, it's always been this sort of choppy, up and down, kill all of the longs, kill all of the shorts period. However, in the background of this, we've still got the big guys, Tom Lee with Bitmine, Joseph Lubin with SharpLink, who are buying a lot of Ethereum in the backdrop of this. So what's interesting to see is even though normally these periods can be very choppy, we have these big sophisticated players in the background, arguably lifting the market up during these certain periods of choppy nature. So what's really interesting is to see this divergence, right? Are they going to carry on fueling and getting money into their treasury vehicles to continue to buy crypto? Or are we going to see things eventually slow down? That can be seen as well with the MNAV compressions that we're seeing. We're seeing MicroStrategy, and here an example, the Ethereum treasury companies. If you
Mm-hmm.
look at the top two, top three, they're trading like relatively close to how much they've bought. So whether this is a longer term trend in which we're starting to see some of these treasury companies lose their premiums because so many people are joining the trade now, at least when strategy was the first ones to do it, the main reason you could probably argue for it commanding such a premium was that no one else was doing it. It was the only way that people who have pensions across the world, I mean, especially where I'm from in the UK, where you couldn't buy ETFs,
Yeah.
strategy was a huge part of that portfolio simply because they weren't going on Coinbase or Binance and buying Bitcoin. Even people in my family were owning strategy. I didn't recommend it, so I'll just say that out there now. But interestingly, now everyone's doing it. How the $1 million question is how it continues to develop, right? It's everyone's now at the party. And what we're all trying to figure out is if this still even is a party. Because with everyone buying all of the Ethereum through these companies now, one of the really interesting things that I found is how low the Ethereum gas fees still are. Now, if anyone remembers from the 2019 to 2021 period, before there were like a plethora of layer twos, layer ones with cheaper gas fees. I remember I used to have to set alarms to wake up at the right time to send transactions through because the gas fees were so high. We've seen nothing like that yet. I know it's gone through the merge and Ethereum has scaled significantly since then, but it's weird for me to see Ethereum hitting all-time highs,
Yeah.
but still that network activity isn't driving the gas fees up, which I might be wrong, but to me, that kind of makes it seem like the biggest demand right now is these treasury companies. It's not necessarily tons of smart contract usage. I know we're seeing tons of TVL increases in some of the big DeFi protocols, but still, if the gas isn't being burned and the gas fees aren't high, then obviously it's a different narrative, it's a different story. So, in terms of Bitcoin, Ethereum, those are the things that I've found the most interesting.
Yeah.
You know, other than that, a couple of big pieces of news that we've had this week is most interestingly, we saw Hyperunit, which is the spot trading protocol part of Hyperliquid, who really, really have set some new records in terms of their volumes of trading. We've seen a huge whale come in, sell off load of Bitcoin to buy Ethereum. And as you can see from this tweet here, they did more in 24 hours on Hyperliquid than Bybit and Coinbase combined. Now, what's so interesting about this is, you know, I remember even in the last cycle, perp dexes, everyone thought perp dexes were going to eat Sex's lunch, right? They thought they were going to dominate.
Yeah.
And now we're finally starting to see a protocol which is starting actually to eat the lunch of some of these big exchanges. And it's a really interesting convergence that we're seeing now that actually, the smart contract stuff, it does work, like not having to KYC, just simply needing to have access to a crypto wallet and funds to transact, take out elements of centralization, which is obviously a truth within Hyperliquid with their number of validators. The core concept is that if you want, you can have crypto in your wallet, buy and sell through Hyperliquid. You haven't got to give your ID or worry about any of these other things. And I think it's such an easy thing to constantly talk about Hyperliquid. But in terms of what they've achieved with the spot trading, I think it's really commendable. And let's see how it continues. Let's see how it continues to develop. We pray to the crypto gods that there aren't any terrible smart contract exploits now, because that really would be a kick in the teeth for a lot of people's hero, which is Hyperliquid. And yeah, that's the big news in terms of the treasuries, Hyperliquid in the market. If
Yep.
the market continues to go through this choppy period into September, I think it's going to it's going to hurt a lot of people. But at the same time, maybe I should be a contrarian to myself and actually, we're done chopping through the market and now we're going to resume business as normal. But again, how far can you go being a contrarian? Sometimes you have to be a contrarian against yourself in this market.
That is a
So
good point. That's a good point. It's definitely very cool to see Hyperliquid doing so well. And I mean, that type of volume more than Coinbase and Bybit combined. In sure, it's just a 24-hour window, but it's a sign we're making waves. It's very cool. Um, Thank you for the insights, Darren. This was a really good highlight reel, I think, of last week's market. And with that, let's kick off the show properly. So I want to welcome everyone to a new Market Cap episode. Market Cap is where funds and firms provide their insight on their activities, sector, and the markets at large to you, our audience of institutional investors and traders, as well as industry professionals. I'm your host and moderator, Stefano, Director, Institutional Services at Alea Research. And with me, I have Darren, our analyst and main panel contributor. And we're joined by Rahul Goyal, Head of Institutional Partnerships at Gauntlet. Welcome, Rahul. Nice to have you with us.
Hey guys, thanks for having me. Thanks, Darren, for the intro. Super interesting, and yeah, great to be here.
Absolutely. We're going to get into it. Obviously, we're going to talk about Gauntlet a lot. But before we do that, you also have a very personal, interesting personal background, I think, or professional background, I should say. Um, I saw you sport a long track record in finance. That includes a stint at JP Morgan and BlackRock, among others as well. Currently, you've been with Gauntlet for 3 years already, so that's quite some time as well. It's always interesting. We talk a lot in this industry about TradFi compared to the market we're in, whatever you want to call it. And I'm curious about your thoughts, right? Like
Mhm.
how, after being here for a while, how do you reflect back on your time in the TradFi markets, as we call it?
Mhm.
And yeah, how did it like prepare you or trigger you for your, or I should ask, how did it prepare you for your time in our industry?
Yeah, for sure. So, I think one thing to caveat is like TradFi is a very big industry with a lot of different people and sectors. I can speak to my personal experience, which, as you mentioned, was, kind of 3 years in investment banking, 3 years at the high yield desk at JP Morgan, and then 3 years in private credit at BlackRock. Um, and so again, this is all my experience, but generally, I'd say high finance is kind of well known for being very hierarchical. There's kind of a pecking order, and people kind of move up the ranks pretty slowly. It's a very mature industry in that sense. It generally moves slow, especially the sectors that I worked in, like private credit and private equity. Uh, Generally, even move slower than more traditional markets. Um, Whereas crypto is really fast, 24/7, 365. And crypto also has a very, very kind of flat hierarchy, flat structure. Some of the most well-known founders are also very, very young. And I think one thing to point out that Darren mentioned with Hyperliquid is like not just the volume, but the fact that Hyperliquid does this with a team of like 12 people, right? Even if the volumes were the same or half of Coinbase, the fact that they're doing it with like 1% or 1/100th of of Coinbase, Bybit, or whatever, I think is also meaningful and probably could only happen in an industry like crypto.
Interesting. Is that what informed your decision for making that jump
Yeah.
as well? Kind of seeing those two horses in the race and this
Mhm.
one going significantly faster and making insane impact with smaller teams. Did
Y-
that, yeah, maybe talk
Yeah, yeah.
about that transition and how it came about.
Yeah, yeah. So I guess there's the short answer and the longer answer. So I'll do one then the other. The short answer really was, I found out about crypto for the first time around 2017. I had some friends who worked at Consensus, the Ethereum company, kind of back in the day. They really got me into it. I bought my first crypto then. Then in 2018, everything blew up. And I didn't sell my crypto, thankfully. I just deleted the Coinbase app from my phone and just forgot about it. And then kind of fast forward to 2020 during DeFi summer, and stuff was picking up again. I re-downloaded the Coinbase app, was very pleasantly surprised and happy that I didn't sell anything. But I just kind of started going back into it and be like, oh yeah, like a lot has changed. There's a lot more primitives and a lot of new things. And then BlackRock, I was working at BlackRock at the time. It's very strict on what you can buy in terms of stocks. So a lot of stocks are restricted. But they sent this firm-wide email out that was like, you can buy anything you want in cryptocurrencies, and we don't care. So I was like, all right, that gives me the full license to like fully go down kind of the DeFi rabbit hole and got really into it. And there's a slightly longer story where I think the real reason or a big reason was I really read this book that had a huge impact on me. It's called The Predator's Ball. And it's actually not about crypto at all. It's actually about high yield bonds and Mike Millikan. And so Mike Millikan is this guy who created like the high yield bond or the junk bond market in the 1980s. And it's essentially the story of him um, doing this. And it's a great, really, really fun story. So I read this before I joined private credit. And then I got into private credit. I was like, wow, this industry is really boring. It's nothing like this book talked about at all. Like I feel like I missed the boat. I'm a little too late for it. And I went back and reread this book, and I mentally replaced every time it says junk bonds with crypto. And I was like, wow, this is exact parallels. Like, this is basically the exact same story where, junk bonds back then were like this kind of Wild West. Everyone thought it was like crazy or only scammers or only really, really sketchy people did anything in junk bonds. It was like well maligned. And then slowly over time, as they essentially started making money and kind of proving people wrong, then slowly the institutional adoption kind of like started creeping in. Uh, there's a point in the story where they hired their first intern from Harvard, and this is seen as a big turning point. We're like, wow, like 3 years ago, nobody from Harvard would even like work at our industry, and now like all these guys want to work here. And so um, there is a lot of parallels, and a big point of that story too is that at the end of it, Mike Milken goes to jail, and the company that he created essentially gets spread out. And so all these people who worked with him essentially all kind of dispersed. But the founders of Apollo, Ares, some of the biggest private credit and private equity names today are all guys who used to work with him. And so I think that they developed a very, very valuable skill set. and a unique skill set and a rare skill set at the perfect time. And then I think Mike Millikan has probably created more billionaires than anybody else, just because he kind of, was one of the first movers here. And so I viewed crypto as very similar to that, in that, like, hey, I think this is kind of a interesting industry. There's a lot of parallels here. When I joined in 2022, especially, a lot of people thought it was sketchy, and the administration was not very positive towards it. But I was like, I'm going to take a bet here, and I think there's a lot of asymmetric upside. And I think that there's going to be essentially convergence within like the old world and the new world, just like how you saw with junk bonds and kind of the old world. And now 30 years later, 40 years later, junk bonds are very boring. No one even calls them junk bonds; they call them high yield bonds, because junk bonds is like too crass. Even now, you can kind of see people don't call it crypto; they call it digital assets. And so
Right.
you can already see the similar semantic shift happening. So I feel
Yeah.
like the trend line is following pretty closely. But yeah, that's kind of a little bit of the longer story of my original thesis.
Man, that's fascinating. And I can relate so much. I started out as a market analyst in fast moving consumer goods
Hmm.
and found out it wasn't that fast moving at all. And I was okay, I need something more exciting. And that kind of led to cryptos kind of similarly. And people at the company were telling me, like, hey, are you sure about that move? It's kind of risky. And like you, I decided to, just go ahead and do it. And now we're here pioneering in the Wild West, it feels like sometimes. And like you said, it's like very flat hierarchies, everything is possible. I'm um I'm very curious about two things. Given your specific background, right? Everything you just told us, in what areas do you think that um that provides you an extra edge over, maybe, let's say, like these guys who come straight out of college and go straight into crypto, who never had like that experience that you had? And on the flip side of that, what were areas where you kind of had to recalibrate a little bit?
Hmm. Yeah, maybe I'll start with or so I think the biggest thing is that traditional finance really gives you a strong basis in the fundamental analysis and research, and always thinking through, like, um, putting together a thesis really well, and always kind of being able to anticipate what your boss is going to say or what the rebuttals to this thesis will be. And so I think it just trains you very well on how to think about analysis. And I'll just give you a concrete example related to MicroStrategy, which Darren mentioned up top, which is, I remember when I first joined Gauntlet, or 2022 or 23, this was after FTX. A lot of people were worried that Saylor was going to be the next big FTX, right? Of like, hey, this
Uh,
guy owns a bunch of Bitcoin. He's for sure going to get liquidated, all this stuff, right? There's a lot of FUD around this. So I read all this and I was like, I don't know, this sounds a little overblown. So I dug into it and I used like the TradFi skills to like dig into like MicroStrategy. And actually, it was, I essentially just did like a credit analysis, right? Of like, okay, why do people think that this company is going to blow up and he's going to have to market sell all of his Bitcoin? Probably because they think there's some bankruptcy trigger, or he has some debt that's going to force him to liquidate his assets or whatever. So I looked into the public filings, which anybody could do. Uh, and I just found out pretty quickly that, like, hey, this is not the case at all. Like, this is at the time, it might have changed now, but back when I'm talking about this, all of his debt was essentially convertible debt. He had a very small piece of debt that was collateralized to the Bitcoin holdings themselves, but Bitcoin would have to fall to like $4,000 or something, which even then was very unlikely for that to actually get triggered. And then you look into it, and there's a dual class structure. So he owns all the voting rights. So he can't be taken out by a, what's the word, like a corporate raider or like an activist investor or something. Basically, I felt like, actually, this guy's kind of bulletproof. I'm not saying he's going to go to a billion, but like his chance of bankruptcy and being a forced seller is actually very, very low. And so I bought, not enough MicroStrategy stock in that situation, but, enough. And I was always kind of pounding the table internally at Gauntlet that, like, yeah, this guy's going to be totally fine. So, I mean, that's a pretty like practical example of like the TradFi experience directly helped, where I think a lot of crypto Twitter, like, nothing I did was crazy. I didn't do investigative journalism. It was just, these are public filings on the SEC website. And I think people just didn't take a kind of close enough look there. So I think that's one very tangible example. And then on the flip side of what I kind of had to learn and recalibrate, I think a really big thing is that the industry just moves really, really quickly. One thing I had to get used to is that there's conferences like every week or every other week. Usually in finance, there's like one or two big conferences a year. But I think if you want to go to a conference every week, you probably could. It's a very small industry and very dense. And so you kind of get to know people pretty quickly. And I kind of go back to, oh, sorry, one other thing I'd point out is that the technical aspect of the industry matters a lot. So like smart contract risk, reading the docs, being familiar with how the technology works is also very important. Whereas in finance, you know, you can invest in finance or technology companies, but you're not really learning the technology on a deep level in any meaningful sense. But
Mm.
here, if you have really no interest in the technology, then it's going to slow you down a lot, or it's going to have to be something you have to like pick up and get used to. Um, but I was always interested in the technology aspect of it. So, but that was definitely something that I had to refocus on.
Makes sense. And yeah, it does move at a neck break speed. It's hard to keep up, and the conferences, man, you can get conference burnout in this industry. But I think it's also, I think it's a bit of a feature, I guess, or an effect of so many of the participants in this industry are like young people, and it's like this generation that, post pandemic as well. It's so easy to move around, and people kind of want to make the most of that opportunity. It sort of goes hand in hand with like remote working and digital nomading, and even these network stays and pop-up cities that actually take place around a lot of the conferences. So that's probably what spurs that on as well. Um, you touched on, well, different things, skill set, your time at Gauntlet. Um, it will be interesting to dive a little bit more into everything that Gauntlet has been up to,
Mm,
because again, the industry moves at neck break speed. So did Gauntlet, the way it started out to what it's doing right now.
mm,
So you guys, like, you've been with Gauntlet for 3 years. Gauntlet has been around
mm,
for 7 years. So actually you've been around for a significant period of their existence. Um, in that time, Gauntlet has been known for working with DeFi protocols such as Morpho, Aave, Uniswap. But recently, the focus in the industry, I think, has shifted a lot more towards institutions. And that's partly what you're focused on as well, of course. But first, I want to ask you, like, how has that transition gone at Gauntlet? Like, how did it start out? What were they focused on? And how has that transitioned over time and evolved from
mm,
research company to, well, what it's known for now, a leading vault manager? But I think you guys
mm,
do so much more at the same time as well.
mm. Yeah, for sure. And so, yeah, like you're exactly right. So, Gauntlet's been around since 2018, and really started off probably the best known for being risk managers for some of the first DeFi protocols like Aave and Compound, um, and and then later Morpho. And I like to think that we were always really big on research, just in general. We've written like 35 different academic white papers on DeFi and on different topics there. Like Tarun obviously is very, very focused on that. It's a big differentiator for us. And I think in general, we've been somewhat early to a lot of the metas that have started. So the company started in 2018, kind of before DeFi protocols really existed, and we're pretty early to how to think about them and how to think about risk management there. On restaking, for example, we were also relatively early in to like eigenlayer and that kind of concept. And I think with vaults as well, we worked pretty early with the Morpho team, and I'll give the Morpho team so much credit for essentially kind of creating the vault meta and the vault primitives. And as you said, like crypto moves so fast with all these new primitives that are coming up kind of all the time. And so I'd really say it's kind of a continuation of some of that work where, hey, now these new vault primitives exist. And now we can take a lot of this risk management expertise and a lot of this DeFi expertise that we've been building up over the last few years and more directly managing on chain assets. Right. And so this way, we can essentially just provide what we do just at scale to a lot more people, to both kind of retail, high net worth individuals, institutions, et cetera. And so, today we have about $1.5 billion of TVL. We started this kind of about a year and a half ago. I'd say really, Q1 of 24. So we've grown pretty fast in about 18 months. And a lot of that is, spread out over mostly Ethereum, but also a good amount of Solana, on stablecoin yield strategies, on ETH yield strategies, on different perpetuals and delta neutral basis trade strategies, et cetera. So a pretty wide range of products there.
Yeah, for sure. you I like that explanation. It's the first time someone explained it to me in a way where it intuitively makes sense how one thing led to another for you guys, and it's
Mm,
just a natural progression. I like that. Talking a little bit more about your specific role, you're head of institutional partnerships. Can you
mhm,
tell us a little bit more about your specific activity? Like, just at a high level, because
mm,
we'll get into some of the specific partnerships and products you've been
sure.
doing. But, on a week to week, what type of conversations are you having and what type of institutions are you, I guess, focused on?
Yeah, yeah. So high level, I think of my job having two kind of primary roles. So one is, hey, we have these existing products that we built that are, I would say we kind of build them for crypto natives first. So these are products that are built for crypto natives first. How do we kind of basically sell them to institutions or get them interested, right? So, we can talk more about it in detail, but like, a vault strategy or the Gauntlet kind of alpha strategy. This is a kind of a crypto native product. How do we translate what this does into more TradFi terms to get more traditional institutions interested and involved? The second part is somewhat of the reverse of, are there essentially institutional first strategies that we can build or institutional first products that we should build that we could operate on crypto? And so that would be some of the levered RWA stuff where that product from day zero is a permissioned product, right? So it's not available to crypto retail, but we're using crypto rails. And so it's essentially just the same idea in reverse, right? Of like, okay, now let's
Yeah.
build a more institutional native product and then go from there. So that's how I would break down my job kind of broadly into two broad buckets.
Right. Okay. That makes a lot of sense. And that also leads me to think that, okay, maybe I'm not sure how it came about that maybe you were, because you were in another role before at Gauntlet, I think, but
Mm,
it makes sense that with your background, you're the perfect guy to do this for Gauntlet at this
mm.
moment,
Yeah, yeah.
right?
It's funny. Yeah. So actually, originally when I joined Gauntlet, I joined as the strategic finance team. So kind of like corporate finance. And that was basically just because I had all this finance background. So I worked
Yeah.
under the CFO. And so that was more typical like financial planning and analysis and modeling and that kind of thing. About a year into the job, Tarun, who's the CEO, kind of came and said, hey, you used to work in TradFi, right? Can you help us with like TradFi go to market? And so originally it was more just strategy. Like, how do we start? How do we start thinking about this? And then kind of gradually and very slowly over time, I started just having two jobs where I was working full time with the CFO and then also working with the BD team. And then they were like, hey, do you want to just join the BD team full time? So I was like, yeah, I probably can't do two jobs at once. So yeah, so it was a somewhat of a, I'll say a relatively seamless transition from one to the other. But again, yeah, like you mentioned, it's a lot of just having the TradFi background, knowing crypto pretty well, and then just being able to merge those two skill sets.
Yeah, of course. Like, I mean, it just makes sense, right? So a BD works a lot of relationships. After so much time being in TradFi market, you speak their language, you know who to go to, et cetera, et cetera. So
Mm,
I can definitely see that making sense. Um,
mm,
you touched on some of these specific products that you guys have been putting together. One of them is the levered RWA product. We're going to get into that a little bit later, but also want to talk about the Gauntlet USD vault,
mm,
USD Alpha vault.
mm,
Um, Obviously, stablecoins are having a big moment right now, not just in our industry, but I think starting in the global economy at large. Um, your this Gauntlet USD Alpha vault. I'm sorry, it's such a long title. Um, it was dubbed as the best risk-adjusted stablecoin yield in DeFi. You guys have seen incredible growth on it so far, and it's composed mostly by Morpho Vault assets.
mm,
Um, yeah, we were also wondering like how does that selection process work
mm,
operationally behind the scenes, right?
mm.
Specifically, like is that optimization engine, if I should call it that, fully automated, or is there still a layer of human oversight involved there?
Yeah, yeah. So Point taken on the name, but I think the idea is the Gauntlet USD Alpha strategy is really, I could think of it somewhat as a capstone of, we've been building a lot of these different vaults, somewhat in isolation. So on Morpho, on Drift, and on other places. And, I think at this point we've got 50 or 60 different vaults. And so, happy to talk about how those vaults specifically work. The idea with Gauntlet USD Alpha is let's create a vault of vaults, or kind of like a best ideas vault, where we will essentially take the best ideas that we've got across these 50 or 60 vaults currently. And, I don't know, who knows, by the end of the year, probably 100 or 200 of these vaults that all do different things. And hey, let's kind of take the best ideas of all of them. And if you don't want to choose between the different ones, we will just say, hey, just put it into this one, and we will reallocate based on what we think is the best risk reward dynamics. And so the reason, if you go look at it, and the nice thing about crypto is it's all public, so you can see exactly where we're allocating. A lot of the current allocations is to our Gauntlet Morpho vaults, but it's not an equal allocation. And so there are certain Morpho vaults that we think are more attractive on a risk adjusted basis at any given time for what we're trying to do here. And, I think over time we'll expand to non-Gauntlet vaults and then outside of Morpho as well. We recently just included Pendle. So you can see we've got some Pendle PT tokens there as well that have pretty nice APYs, right? So 14% APYs relative to everything else. And so, we just think it's a nice way to boost some yields here.
Very nice. Yeah. This is indeed the cool part about crypto, right? That everything is transparent. You can look everything up, and it's a pretty good track record so far. You mentioned Morpho, Pendle. Is the team planning to expand large vault allocations to other protocols? And you briefly touched on it. I wonder, what drives those types of decisions? Is that primarily the yield opportunities, or is there also? I'm assuming yes. There's also a risk management consideration component to it, right?
Yeah, exactly. So I think the idea is maximizing the risk adjusted yield, right? So given each unit of yield that you're getting, what is the risk associated with that, and then trying to optimize that. And so I think if a lot of the assets are more towards the frontier or the core vaults, which are the higher risk or medium risk vaults. And so we have a pretty good idea of the different risks that are associated with Pendle and with some of these kind of underlying assets. And so we feel like we can make a pretty good assessment there of what the right allocations are. And it's interesting that, as I mentioned, everything in crypto moves fast, which I think has been a kind of running theme so far. In TradFi, right? So the way to break down why is the yield what it is in crypto, it's essentially it's essentially supply and demand, right? The yield is say 9% because both borrowers and suppliers have agreed that that's the price that they'll pay right now. But if it goes to 9.5%, there's probably a lot of borrowers who think that's too much and they'll unwind their trades, and a lot of suppliers who think I wouldn't supply at 9, but I will supply at 9.5. And so you do have this kind of constant market that's always moving. And so a lot of our allocations are somewhat market making or feeding into that different changes, right? Where there'll be times when somebody will just pull out some supply just because they want to reallocate or buy ETH or buy Bitcoin or something else, and the rates will spike. You can argue there's not a real reason that the rates spike. That doesn't really reflect the risk of the underlying. It just reflects a risk in the flows or a mismatch in supply and demand dynamics. And so it's logical and rational to allocate more towards that asset. And so that's somewhat how we think of it as well, where there's essentially a medium to long-term risk consideration that needs to be into consideration, but also a short-term liquidity. And where is liquidity going to, and who's moving liquidity faster versus slower, et cetera.
That makes sense. It occurs to me that earlier you were saying because of your background in traditional finance, that gives you a solid basis in the fundamentals. And it occurs to me that I think because of that, you are somehow able to break down these things so simply, which I really appreciate. Um,
Thank you.
this is really good and insightful. Um, Moving beyond stable coins, because
And maybe
that's
just one
like
more point. If I can just add one more point to that as well.
please do.
So something, I think this is research we're going to put out soon. But one thing is if I show this podcast to my TradFi friends, they'll say, okay, great, the yield is 10%. What is the default rate, or what is the actual risk that we're talking about, right? How do you quantify that? So it's very interesting in TradFi, right? So if you think of high yield bonds, which we talked about with Mike Milliken, um, the long term, the yield on high yield bonds is typically about 8%, right? The default rate on the high yield bonds, which is given a universe of high yield bonds, how many of them are in default at any given time, is usually like 3, 4, 5%, right? But what's interesting in crypto, and I think nobody's thinking about it this way, but they should be, is that if the yields are 8 or 9% in crypto and the yields are essentially the same, right? Let's just argue the yields are the same. The default rate on the crypto 8 or 9% is like 10 basis points. So it's way, way lower than the default rate in TradFi, which I think is very counterintuitive because people in TradFi kind of naturally assume any lending in crypto must have a much higher default rate or be much more risky. But actually,
Uh-huh.
the very counterintuitive idea is that the default rates are actually much, much lower. And a big reason is because the market is much more liquid. And because if there's bad debt, you can essentially take a flash loan and essentially immediately sell and liquidate the position. And so the chance of bad debt for a major like Bitcoin or ETH is essentially zero because you can liquidate so easily. The chance of bad debt for like a pendle position or a very long tail asset is slightly higher because there's less liquidity for flash loans, but you can take
Okay.
all that into consideration. And so I think nobody's done this yet. It was just a side by side comparison of like what is the default rate on each of these, and I think people will be pleasantly surprised or maybe a little shocked to find out like that crypto comes out much better ahead.
Yeah, that's
That's
crazy.
that's an interesting point, actually. Yeah, I didn't know that, Darren.
Mhm.
Well, I think because we've seen such like liquidation cascades and we've seen protocols be laden with bad debt, but then actually the way that explains it, like it does kind of make sense in a way because our markets are open 24/7,
Yeah.
right? Even if any of us here opened went into a borrowing or lending position, right, and prices started moving quickly, anytime we want to, we can go and close that position, right? We're not waiting for markets to open. We're not, maybe within even bigger organizations, there's elements of paperwork and, the calls have to be made to the right person. Oh, no, he's on lunch break. She's off sick today. There's elements of human fuckery that get taken out of it. And I think that is such an interesting point. And also to add to what Rahul was saying, it's like we've seen a lot of protocols get bad debt. And we've seen a lot of them overcome it. We've seen, they've never had bailouts. Like for example, where I'm from in the UK, the Bank of England had to intervene within their bond market about a year ago. Whereas, like, in crypto, they never had that. Like, there's multiple examples. There was the whole saga with Curve, where they were selling off, like, locked Curve bags, different investors, OTC. Everyone thought that was the death spiral. But actually, it's still functioning. They have their products and people can borrow and lend there. Whereas, like,
Yes.
you compare that to, again, I'll use the UK gilts as an example, where they're hitting like 25, 26, 27 year highs now. And our little sort of smart contract based platforms just carry on functioning. And I think
Mhm.
it really does say a lot that that's one of the powers of smart contract technology is that sense that we're not relying so much on two counterparties or two people interacting with each other. They function as intended. I think it's often easy to get hung up about lack of adoption and oh, DeFi was going to save the world, eat the world, and all of these things. But actually, now I think about it after how Rahul explained it, I think there is actually quite a lot to be positive and excited for within the space.
It made me
Yeah.
wonder two other things I'd just say is this analysis, I agree, there's a little bit of survivorship bias for sure, right? So if you did this analysis on Mango, I think the default rate is 100. I think that protocol shut down because of an exploit. So there's an element of survivorship bias for sure. And I think you'd run this on an Aave, a Compound, or a Morpho, protocols that have been around for a long time. That's really where it makes sense. So I wouldn't try to act like this applies to every single DeFi protocol. It just as a second point. The second point I'll say is liquidations are not bad in and of themselves, right? So liquidation cascade is not inherently bad the problem is insolvencies. So the problem is that the price falls so far below the point where it's profitable for a liquidator to liquidate it. That's what actually causes bad debt. But often for like a Bitcoin, right, or a major, if the price does fall like 30% in like an hour, but it does climb back, a position that was previously bad debt can go back to health as well. So that is that concept. And then the third thing I'll just say is that the closest analogy to like morpho lending is if you go on Schwab, you can get a loan against your stock, right? And so like stock lending or margin lending. The key difference with crypto is that there aren't earnings, right? So, for example, let's just say you have you you were super margined on Nvidia the other day, and then Nvidia stock is like down like 5%, because there's like a specific discrete event and the stock trades down. There could be more chance of a bad debt there because there's these more like specific examples and specific um, events that happen, whereas crypto is essentially flowing continuously, where, if you report earnings after hours and earnings are bad, there's often like less liquidity than if you reported them in the middle of the day. And so you can have wider gaps and wider ranges than you'd otherwise have. All of this to say that I essentially agree with Darren, right? Just that like the fact that like the market's being so 24/7, 365. And again, a lot of this analysis is really focused on the majors. If you looked at some of the smaller assets, it might not be the case. But I think there's still kind of a worthwhile argument there to make.
Yeah, these are fair caveats. And I think what you just described it's a great argument for what you referred to earlier, that you were saying that these like TradFi is basically gonna converge. I don't remember your exact wording. I don't want to put words in your mouth, but you think you were alluding to some sort of event or process where traditional markets will basically converge with crypto markets or like adopt the technology. Maybe that's a bit of an interesting tangent real quick. Like how do you foresee that playing out?
Yeah, I always say that I think finance people are very pragmatic and they'll do what makes money. Whereas
Yeah.
maybe that's not, I think tech people can be sometimes a little bit more ideological, or I would say it this
Oh,
way. I have tech friends who I think will never adopt crypto ever. And I have finance friends who are much more open to the concept of it. So generally, I
man.
think, and you've kind of seen that with Bitcoin is maybe the most obvious example where, when the ETF came out and just like when the price started going up continuously over a long period of time, I think that's when people just naturally got interested. And then that kind of creates this virtuous cycle where, then crypto people get richer, they donate to the right politicians. These politicians want to keep some of the money flowing. So they have good regulations. And so it is a case of like winning solves everything. Like as long as like, and I don't want to act like the prices to go straight up in a line for everything to work out. Like, recessions happen, like cycles happen. But
Sure.
just the more point of like, I think to answer the question directly, I think if people can figure out the way to make money on it, they'll be interested in it. So maybe the ETFs are the best example where I think for a very long time, people tried to get banks to do crypto stuff. And I think beyond the fact that banks are very regulated, it was tough for banks to figure out how do I actually make money in crypto. It's very interesting that the ETF players and the buy side companies like BlackRock have figured out, hey, I could just put this into an ETF and a lot of people will buy it. And so it's not surprising that the companies who are currently making money on crypto are the most bullish on it, talking about it the most, looking to expand their offering the most. And I think the companies that are still trying to figure out how do we play this space are not spending too much time there, right? Like it's, if you look at it just outside of the crypto industry, it's a very logical analysis where if you're the CEO and there's this cool industry, but you don't know how you're going to profit from it, you're probably not going to spend too much time on it. But if you can see, hey, there's already a very, very profitable group of this company that does crypto, yeah, let's double, triple, quadruple down there and like, let's keep that going.
Yep. Bottom line runs everything. Um, that makes a lot of sense. We talked a little bit about like the stable coins, and I want to shift a little bit to another segment that or sector that's really taken off is tokenization, RWAs. Partly probably because of the clarity on the regulatory front that we're talking about right now. Um, all the way back earlier, you mentioned the levered RWA product. A
Mhm.
few months ago, you launched one together with Apollo.
Mhm.
Um, Maybe you could tell us a little bit about that product, how it works, and why you chose to partner with Apollo.
Yeah, sure. So the idea, even stepping back, the fundamental idea that we're trying to do is has already existed in crypto. So if you think of like ETH looping, right? There's the idea that like, perhaps staked ETH yields, say like 3%, you can borrow ETH at say like 2%, and then you can put this ETH 3% ETH up as collateral, borrow ETH against it, and then just keep looping this trade. So this concept has
Yep.
existed in crypto native world for a while. I think our innovation was just, hey, we can do this with RWA assets as well. And so uh, we've been thinking about this for a while. We thought about doing with a tokenized treasury, but the yields of tokenized treasury is about 5%. The borrow rates never got low enough to make the trade really work on a sustainable level. But
Okay.
then Apollo launched this private credit fund, which yields kind of 8 or 9%. And, the light bulbs went off of like, okay, now we can actually do this. And so the fundamental idea, which I think is pretty standard for a lot of crypto people, is you take this Apollo RWA that's tokenized, you put it up as collateral, you borrow dollars against it for a lower borrow rate than the Apollo fund yields, and then you use those dollars to buy more of the underlying Apollo fund and then put it back up as collateral. And the idea is you can loop this, kind of as many times as you'd like, or to hit a certain LTV. And the net benefit is that you go from an unlevered return of 8 or 9% to a levered return of 14 or 15%. At a fairly low LTV, about 50%, which is pretty typical in more TradFi world. Um, and the RWA issuer gets essentially to multiply their TVL, which means multiplying their fees. Um, and we're also just adding more use cases for RWAs to exist on chain. So there's always, tokenization has existed basically since the start of crypto. And I think there's always been a question of how do we actually use this, or how does this fit into what we're doing in the wider lens of crypto? And I think what we've done here is at least try to start answering that question of, hey, now you can use these RWAs in DeFi, and borrowing against them and looping them is just one thing you could do. You could conceivably, make Pendle tokens out of these RWAs as well, like essentially strip the yield portion and the underlying portion, like Pendle does. You could conceivably do this with RWAs, or perps with RWAs or other things like that. And so, we're pretty excited. We launched this product with Apollo about 3 months ago. They've been really, really great partners. And about a week ago, we launched another product with Falcon X, which is slightly different, but essentially the same kind of underlying concept. We're, I can't say too much. We're going to do another kind of big launch next week, and then planning on rolling out a few more similar RWA products in the next few kind of weeks and months. So, we've seen a ton of interest from a lot of RWA issuers, a lot of RWA investors, a lot of folks who are just interested in what this is. And so, we're pretty hopeful and optimistic that this is going to be, the start of a huge new kind of subsector within crypto.
That's exciting. I was just curious about how how can these, you have one with Falcon X, you have one with Apollo. How do you generally like differentiate between like parties to partner up with? Like what goes into that decision? Um yeah, because yeah.
Yeah. Yeah. So I think it's three things. So one is, both Apollo and Falcon X are very, very well known. So it's always helpful to work with kind of a large, well known tokenization platform. Um, And one big reason is also because they often have the distribution. And so, we're still a relatively small startup. So to the extent that the RWA issuer can help with distribution, kind of they have existing clients that would be interested in this, that's, the ideal situation where Falcon X, for example, uh, had, I think, kind of 40 or $50 million of TVL of clients who'd be interested in running this trade before we even started working on it. So that just made the process a lot easier. I'd say the yield typically at a minimum usually needs to be about 7 or 8%, just because the borrow rates fluctuate, and you can't take low borrow rates for granted. Especially, we're in a bull market now. The borrow rates for even Bitcoin and ETH are still 5 or 6%, so kind of edging up there. So the underlying yield needs to be relatively high to make sure we can actually do the loop on a consistent basis throughout the market cycle. Um, and then the third thing is that it needs to be redeemable. Um, you know, at max to a quarter and ideally much shorter. And what I mean by that is that, for example, like, could I tokenize my house and like get leverage or something on it? In theory, you could, but the problem is that if you ever needed to liquidate that asset, there's no way to actually liquidate it in a clean way, right? So like you'd have to do some off-chain stuff. The nice thing about both Apollo and Falcon X is that they have essentially on-chain liquidation mechanisms or on-chain redemption mechanisms that a third party could execute without too much work, too much effort. So that's a key part of it as well. And we're also talking and working with more public credit RWAs, and where you can redeem the asset within 2 or 3 business days. So that's also, a great situation, just because you can trade in and out of it. You can lever and relever it a lot easier. And if it ever needs to be liquidated, it can be liquidated and redeemed much faster.
That makes sense. Okay, so I can already see like the decision making that goes into these partnerships. That's very insightful. You teased a little bit just now that there are more coming. You cannot mention too much about which ones, who with. I understand, but this is a clear sign. I have to conclude that you see that the demand for these type of products is still a lot deeper. How much, like, how big is the demand for products like this? If such a question could be answered at all.
Yeah, so I think it's very interesting, because I think we created this new product, and I always try to tell people, like, it's not that new. It's very similar to what you already know. Like in crypto world, it is very similar to, levered looping products that exist. And I think in TradFi, the way I would explain it is it's essentially back leverage, or it's essentially like a margin loan, right? So in TradFi, putting crypto aside, if you own, say, like $1 million of the Apollo fund, right, you can go to some other bank or like a First Republic or something and say, hey, can you give me a loan against this Apollo position that I hold? And they'll give it to you for 20, 30, 40, 50% LTV. And so this concept already exists in TradFi, and we're really just bringing this to DeFi now. But the biggest benefit is that the process is way, way quicker. So, whereas if you do this in TradFi, try to get back leverage on an existing private credit or private debt position, it could take weeks to months. And in DeFi, you could do it, I think, in an hour, like within a few minutes, if everything's really set up properly. And so conceivably, you could essentially see the TAM being anybody who wants back leverage on kind of any asset could do this in DeFi versus doing it in TradFi. So that in and of itself, I think, is a huge TAM and a huge market. And then broadly, right, I think there's a big push to, hey, can we just tokenize every single asset that exists, or like tokenize the world? And I think the idea here is that, yes, you can. And then here are the additional things. Like, we're essentially just porting over all the different use cases that you can already do in the traditional world into the DeFi. And so, if you look at whatever like the stock margin lending or back leveraged TAM is today, a lot of that could be done in DeFi, but just in a much faster, easier way. And so I think this could become huge. The other thing I'll just tease is that it doesn't have to be just credit. It could be equities, commodities, or kind of anything, any conceivable asset, really. Credit is just easy because the math makes sense, because, okay, the underlying yield, say 10%, the bar rate is 5%, so you can math that up pretty easily. But you could also do this with equities, right? So I'll use the example, people do this with Bitcoin. So Bitcoin has no underlying yield, but people will put $100 of Bitcoin up as collateral, borrow $50 of USDC against it, pay 5% borrow rate, use that $50 to buy more Bitcoin, to go levered long Bitcoin. So again, you can do this with equities or commodities or kind of anything else as well. So yeah, I think there's a ton of open white space there.
Yeah, sounds like sky's the limit, but there's definitely still a lot of potential there. Um, all right. Before we wrap up, um, still looking forward a little bit. Again, I know you cannot share too much about these products that are coming up. Are there other maybe exciting
Hmm.
developments that we can
Hmm.
expect coming out of Gauntlet? And also, what's the best way to find you and the Gauntlet team if people want to get in touch?
Yeah, for sure. One thing we didn't really talk about was integrations. So we're working with a lot of kind of fintechs, custodians, um, kind of like Web2 front ends, to integrate some of our vaults onto their front end products. And so you don't even have to have a wallet or go on chain to deposit into Gauntlet USD Alpha. You could just do it from whatever fintech app you're most comfortable with, like a Robinhood or Coinbase or whatever like that.
Wow.
So we've already got a few of these live. We're going to announce a few of these coming up, and we're working with a few of these now. But I think that's also a really interesting angle. I don't know if this is a hot take, but my general view is, as of August 28th, 2025, anybody who would directly be on chain is already on chain. It's not like 2016 where some people haven't heard of Bitcoin or people don't know it. I think at this point, people know what DeFi is. And if they're not on it already, they're not interested. But I think the way to get those people is to just integrate it to what they're already used to. So some people open their Robinhood app 20 times a day, just to, like, check on their
Yeah.
stocks. If we could just integrate our products into that app, right, it kind of achieves the same goal without forcing them to go on chain. So, I'll call and leave with that. And yeah, to find out more about me, I think we've got my Twitter, Telegram here. It's at
Yep.
Rahulio's1. You can find me on LinkedIn as well. And then Gauntlet is gauntlet.xyz.
Amazing, man. Definitely a smart play on the distribution. And hot take noted. We'll have to have you
Yeah,
back.
we'll bookmark it.
Yeah, we'll bookmark it. We'll have to have you back at some point and see how it went, bro.
It does make sense,
Uh,
though, what you say, Raul. Like, in a permissionless industry, it's kind of counterintuitive for people to be expected to go through all the lengths that maybe some of us went through to utilize DeFi, whereas it's a permissionless piece of technology. Anyone, like you see with Phantom utilizing Hyperliquid perps and the announcement from Rabby, maybe the future is simply that most of these fintechs, you have one-click deposit, you can deposit your fiat on that platform, and boom, it's in all these different vaults, all these different borrowing and lending platforms. Like, there's no reason really, apart from the fact that we love crypto and DeFi, that the average person has to, have a DeFi wallet, have all of these excessive things. When in reality, if you want masses of people to use something, you got to make it easy.
Easy.
So I completely agree with you.
Yeah. Yeah, great closing note. Well, like I said, let's have you back and see how things have developed since then. Rahul, thanks for coming on the show. It was very insightful. Thank you also to everyone tuning in. It's always a pleasure. If you enjoyed this, you can access more insights in the following ways. For in-depth reports, many of them publicly accessible, you can join our research platform. For protocol and market summaries and highlights, you can subscribe to our newsletter. And for daily news updates, you can join our Telegram channel. All the links are in the bio. And of course, you can tune in next time. We're live every Thursday, 10 a.m. Eastern Time on X and YouTube. This was Market Cap, where funds and firms provide their insight on their activities, sector, and the markets at large to you, our audience of institutional investors and traders, as well as industry professionals. See you on the next Market Cap.
Thanks again, guys.